Hello and welcome to this special report here at XM.com. We'll be discussing the U.S. economy, market forecasts for the Fed funds rate, and the outlook for the dollar. I'm Maria Pachordes, and joining me is Senior Investment Analyst Howard Lumbos-Bisuros. So Howard Lumbos, last week the U.S. dollar suffered a blow after the CPI data showed that inflation cooled by more than anticipated in October. Is the U.S. economy expected to slow in the fourth quarter? And what will this mean for the Fed and upcoming interest rate decisions?
Hello, Maria. Yes, indeed, the greenback suffered after the CPIs, and that was the second hit in less than 2 weeks, with the first coming after the disappointing jobs report for the same month. Now, given that the Fed is conducting monetary policy looking at both inflation and employment, easing conditions on both fronts convinced investors to price out any chance for another hike by the Fed and to price in around 90 basis points worth of rate cuts for next year. Now, as for the economy, yes, it is expected to have slowed in the fourth quarter, with the Atlanta Fed GDP now and the New York Fed nowcast models projecting growth rates of 2.2 and 2.5% respectively. But with interest rates at such high levels and the economy growing at the stellar pace of 4.9% in the third quarter, in my opinion, such a slowdown appears quite normal. What's more, the Fed's own economic forecasts point to an economy that could slow to 1.5% in 2024 and then reaccelerate to 1.8% in 2025, with inflation easing to 2.2 by the end of 2025 and hitting the 2% objective in 2026. And that's with a dot plot projecting one more hike and only 50 basis points worth of rate cuts for 2024. Therefore, the big question moving forward is who is right, the market or the Fed?
So taking all this into consideration, how might the dollar perform in the near term? Which currencies have the potential to outperform the greenback?
Now, in the near term, there are still chances for the dollar to rebound, as there is nothing currently justifying almost 100 basis points worth of rate cuts. Therefore, should incoming data continue to point to a US economy that is doing better than its major peers, investors may be eventually convinced to lift their implied path. Even if new rate hike bets do not resurface, investors could scale back a decent amount of basis points worth of cuts. It is still early to start arguing about a bearish reversal in the dollar, especially against the pound, the euro and the pound, which could stay in a weak position for a while longer, and I will explain why. The Eurozone seems to be headed for its own recession, which could eventually prompt the ECB to start cutting its own rates before the Fed does. And the UK economy is also in a bad shape, and following the larger than expected slowdown in UK inflation during October, and also disappointing growth-related data, investors may be tempted to continue bringing forward their Bank of England rate cut bets. Now, currencies that have more chances in outperforming at some point the dollar may be the risk-linked Aussie and Kiwi, as expectations of several rate cuts by the Fed have already translated into increasing risk appetite, and this is evident by the latest rally in Wall Street. What's more, with investors pricing in not even a full 25 basis points cut by the RBA in 2024, the Aussie could perform even better. However, this may be a story for next year when the Fed actually begins to cut rates, and this will result in the slide in short-dated treasury yields to accelerate. The yen could also perform better than it did this year if the Bank of Japan abandons its yield curve control policy, although improving risk appetite is usually not a plus for this currency.
Harlambos, thanks so much. And thanks for joining us for this special report here at XM.com.